There is a ghost that haunts Wall Street. It doesn't rattle chains or whisper in the dark. It lives in the daylight, inside the minds of the smartest people in the room. It's a phantom that has cost brilliant PhDs, quantitative analysts, and financial wizards more money than any market crash in history. This ghost is the deeply held belief that intellect is the key to wealth, that with a powerful enough calculator, a complex enough algorithm, or a quick enough mind, you can outsmart the market. It's a lie. A beautiful, seductive, and catastrophically expensive lie. And for decades, one man in Omaha, Nebraska has built an empire valued at nearly $1 trillion, not by being the smartest man in the game, but by understanding that the real game isn't played on a spreadsheet. It's played in the 6 inches between your ears. Warren Buffett's greatest secret, the one that separates him from the graveyard of financial geniuses, is a simple, emotional rule, a principle of temperament so profound yet so overlooked that it acts as a permanent, unbreakable shield against the market's worst follies. He discovered that in the arena of investing, the person with a 160 IQ who is a slave to their emotions will be annihilated by the person with a 110 IQ who has mastered their temperament. This isn't a folksy platitude. It is the fundamental law of financial gravity, and understanding it, truly internalizing it, is the only path to real, lasting financial freedom. We are about to embark on a journey deep into the mind of the world's greatest investor, but we are not looking for complex formulas or secret stock tips. We are looking for the 5 foundational pillars of temperament that underpin his entire philosophy. These aren't just ideas. They are operational codes for your own mind, mental models that will allow you to see the market not as a complex puzzle to be solved, but as a psychological game to be won. This is the final promise, that by the end of this analysis, you will no longer seek to be the smartest investor, but the wisest. And in that shift you will find the power to not just survive the market, but to make it serve you for the rest of your life. The first pillar of Buffett's temperamental fortress is perhaps the most misunderstood. It is often confused with a lack of ambition or a fear of the new, but in reality it is the highest form of intellectual discipline. It is the principle of the circle of competence. This isn't about knowing a lot. It's about knowing the precise boundaries of what you know. It is the humility of true intellect. The world is filled with smart people who believe their intelligence is a universal key, capable of unlocking any door. A brilliant surgeon assumes he can master stock picking. A successful lawyer believes she can time the commodities market. This is the hubris that temperament exists to destroy. Buffett's genius isn't in understanding every industry or every new technology. His genius lies in his iron-willed discipline to say, "I don't know," and to stay far away from anything that falls outside the stark, clear lines of his own understanding. This is not an intellectual failing. It is a temperamental triumph. It is the emotional control to resist the siren song of the thing everyone is talking about, the hot trend, the new paradigm, and to instead remain planted in the soil you know best. To truly grasp the power of this discipline, we must travel back in time to the late 1990s. The world was electric. It was the dawn of a new millennium, and the air crackled with the promise of the internet. The dot-com bubble was inflating to biblical proportions. Companies with no profits, no revenues, and sometimes no viable products were being valued in the billions of dollars. It was a gold rush, and Wall Street was selling the shovels. Analysts, fund managers, and the media created a narrative that was impossible to resist. This time it's different. Old metrics like price-to-earnings ratios were declared obsolete, relics of a bygone industrial era. The new metric was eyeballs. How many people were looking at your website? The world had gone mad, but it was a madness that made people rich, at least on paper. And in the middle of this roaring party stood Warren Buffett, looking like a man who had shown up to a rave in a tweed jacket. He wasn't buying, he wasn't participating. He was, by his own public admission, sitting it out. In 1999, at the absolute peak of the frenzy, Berkshire Hathaway's stock dramatically underperformed the market. The S&P 500, fueled by tech stocks, soared nearly 21%. Berkshire Hathaway lost 20%. The headlines were brutal. Barron's famously ran a cover story titled, "What's Wrong, Warren?" The article questioned if the Oracle of Omaha, then nearly 70 years old, had lost his touch. Had the new economy simply passed him by? Was he a fossil, clinging to outdated ideas about cash flow and tangible assets while the world rocketed into a digital future? The pressure was immense, not just from the market, but from his own shareholders, from the media, from the entire zeitgeist of the era. A person of lesser temperament would have cracked. They would have felt the sting of ridicule, the FOMO, the fear of missing out, and the intense psychological pressure to adapt, to prove they still got it. A smart person would have tried to learn the new game, to build models for internet companies, to justify the unjustifiable valuations. But Buffett's temperament held firm. His response was simple and unwavering. He said, "I don't understand them." He explained that he couldn't project with any certainty what the cash flows of these companies would look like in 5 or 10 years. He didn't know who the winners would be in this chaotic new landscape. Because he couldn't understand them, he wouldn't invest. It wasn't that he was intellectually incapable of learning about technology. It was that he had the temperamental discipline to recognize the difference between a superficial understanding and true, deep, predictive knowledge. He knew the boundary of his circle of competence, and it did not include nascent technology companies with ethereal business models. He was willing to look foolish, to underperform, to be called a dinosaur, rather than betray that core principle. And then, in March of 2000, the bubble burst. The Nasdaq, which had peaked above 5,000, began a catastrophic collapse. By October 2002, it had fallen nearly 80%. Companies that were once worth billions evaporated into nothing. Pets.com, Webvan, eToys, they became punchlines. The geniuses who had mocked Buffett were wiped out. Their investors lost everything. Trillions of dollars of phantom wealth vanished. And Warren Buffett, the man in the tweed jacket, stood untouched. His old economy businesses like Coca-Cola and Gillette continued to churn out cash. He hadn't just avoided the crash. He was now armed with a mountain of capital, ready to buy the wonderful businesses that had been thrown out with the bathwater of the tech wreck. His vindication was not a result of superior prediction. He never predicted the crash. It was a result of superior discipline. He didn't need to know when the party would end. He just needed the temperament to not go in the first place, because he knew he didn't belong there. That is the circle of competence in action. It is an emotional shield, not an intellectual tool. The psychological principle that makes the circle of competence so powerful is a direct counterassault on one of the most pervasive cognitive biases, the Dunning-Kruger effect. This effect, identified by psychologists David Dunning and Justin Kruger, describes a phenomenon where individuals with low ability in a specific domain systematically overestimate their competence. In essence, they are too incompetent to recognize their own incompetence. The world of investing is a perfect petri dish for this bias. A novice investor reads a few books, watches some financial news, and makes 1 or 2 lucky trades in a bull market. Their initial success floods their brain with dopamine, creating an illusion of skill. They mistake luck for genius. They believe they have cracked the code. This is the point where they are most dangerous to themselves. Their small amount of knowledge feels like a vast expertise, and they begin to venture outside of any area they might genuinely understand. They start trading options, speculating on biotech startups, or buying obscure cryptocurrencies based on a tweet. They have climbed to the top of what Dunning and Kruger call Mount Stupid, the peak of overconfidence that precedes a humbling fall into the valley of despair. Buffett's temperamental demand for a circle of competence is a deliberate system for never ascending Mount Stupid in the first place. It is a preemptive strike of humility. By consciously defining what he doesn't know, he prevents his own brain from tricking him into a state of overconfidence. This is deeply connected to another powerful psychological force, the fear of missing out, or FOMO, FOMO is not a rational calculation. It is a primal social emotion. It's the anxiety that others are experiencing something rewarding from which we are absent. During the dot-com bubble, the stories were everywhere. Neighbors, cousins, co-workers getting rich overnight on some tech stock. This creates an almost unbearable psychological pressure. The brain screams, "Everyone else is getting rich and you're sitting here doing nothing. You're a fool." This is not an intellectual argument. It's an emotional attack. The temperate investor, the Buffett-style investor, has built the mental fortitude to withstand this attack. They understand that the pain of missing a speculative bubble is temporary and insignificant compared to the permanent capital loss of participating in one and getting caught in the crash. They have rewired their emotional response. For them, the feeling of staying within their circle, even if it's boring, is a feeling of safety and strength. The feeling of chasing a hot stock they don't understand is a feeling of anxiety and weakness. They have flipped the script on FOMO. Their greatest fear is not missing out on a trend. It is the fear of being lured into a game they don't understand and losing capital that they worked so hard to accumulate. This is a profound psychological rewiring that separates the amateur from the professional, and it has nothing to do with IQ. It is the purest expression of emotional discipline. So how do you, as an individual investor or an entrepreneur managing your own capital, apply this? How do you translate this theory into a practical blueprint for your own financial life? The first step is to build your circle of competence, not based on what you want to know, but on what you already know with deep, intuitive familiarity. Get out a piece of paper or open a new document. Title it My Circle. Now you're going to create 3 lists. First, list your professional expertise. What do you do for a living? Are you a software engineer, a doctor, a marketing manager, a plumber? Write down the industry you work in and the specific knowledge you possess that few others do. If you're a dentist, you understand the business of healthcare suppliers like Henry Schein or Patterson Companies better than 99.9% of Wall Street analysts. If you're a logistics manager, you have a ground-level understanding of companies like UPS, FedEx, and the trucking industry. This is your first, most powerful edge. Second, list your deep, genuine hobbies and passions. Not things you're vaguely interested in, but things you spend hours reading about for fun. Are you obsessed with video games? You have an innate understanding of companies like Activision Blizzard or Electronic Arts and their competitive landscape. Are you a fitness fanatic who knows every supplement and piece of gym equipment? You have a unique insight into that consumer market. Are you a home cook who understands the power of brands like McCormick or Kraft Heinz? This is a source of proprietary knowledge. Third, list the subjects you consistently and voluntarily consume. What nonfiction books do you read? What trade magazines or websites are you drawn to? This reveals the areas where you have a natural curiosity, which is the fuel for continuous learning. Now look at those 3 lists. The intersection, the overlap between your profession, your passions, and your curiosities. That is the starting point for your circle of competence. These are the industries and businesses where you are most likely to be able to judge their long-term competitive advantages and value them with some degree of accuracy. The next step is the most critical, and it is an act of pure temperament. Create another page and title it The Too Hard Pile. Everything, and I mean everything, that is not squarely within the circle you just defined goes into this pile. A hot biotech stock that a friend recommended? Too hard pile. A complex financial derivative? Too hard pile. A mining company in a politically unstable country? Too hard pile. The discipline is to be ruthless. You are not allowed to cheat. You don't get to say, well, I'll just learn about this. No, if it's not in your circle today, it goes in the pile. This act of sorting is not an intellectual exercise. It is an emotional one. It requires you to kill your ego. It requires you to admit ignorance, to resist the temptation of easy money, and to be content with a smaller, more manageable universe of opportunities. This isn't about limiting your potential. It's about focusing your power. Your goal as an investor is not to have an opinion on every stock. It is to have a deeply informed, high-conviction opinion on a handful of stocks and to act only when the opportunity is overwhelming. This blueprint, this process of defining your circle and religiously maintaining your too-hard pile, is the practical application of Buffett's temperamental genius. It simplifies the entire process of wealth management, transforming it from a stressful guessing game into a patient search for opportunities within your own backyard. To fully appreciate the wisdom of this path, we must examine its opposite. We must walk the path of the 99%, the path of the antithesis. This is the path of the intellectually gifted but temperamentally flawed individual who believes their brain power is a skeleton key. Let's call him Dr. John. Dr. John is a brilliant cardiac surgeon. In the operating room, he is a master, precise, knowledgeable, and confident. His high IQ and years of training have made him a success, and he has a significant income to invest. He reasons quite logically that if he can master the complexities of human anatomy, he can surely master the stock market. He scoffs at the simplicity of, "buy what you know." It seems beneath him. Instead, he dives into the deep end. He subscribes to advanced trading platforms with complex charting software. He learns about stochastic oscillators and Fibonacci retracements. He believes he can find patterns in the market's noise that others miss. His circle of competence is medicine, but he sees that as a limitation. His ego craves a bigger, more exciting challenge. He gets interested in a hot technology company, let's call it Innovate Corp, that is developing a revolutionary new AI chip. He reads their press releases and a few glowing analyst reports. He doesn't truly understand the semiconductor industry, the competitive pressures from giants like Nvidia or Intel, or the capital intensity of fabrication plants. But he understands the task story, and the story is exciting. He builds a complex spreadsheet, projecting astronomical growth rates far into the future. He convinces himself, through the sheer force of his intellect, that the stock, currently trading at 200 times earnings, is actually cheap relative to its future potential. He buys a large position. For a while, the stock goes up, confirming his genius. He feels a thrill that his surgical successes don't provide. This is a different kind of validation. But then, the market turns. A competitor announces a slightly better chip. The Federal Reserve raises interest rates, making high-growth stocks less attractive. Innovate Corp's stock begins to fall. Dr. John's intellectual framework is useless now. His spreadsheet can't account for fear. He watches the value of his position drop 10%, then 20%. The confidence he felt is replaced by a gnawing anxiety. He starts checking the stock price obsessively, between surgeries, at dinner, in the middle of the night. His emotional discipline, so strong in the operating room, is non-existent here. He is outside his circle, and he is flying blind. The news gets worse. The company misses its quarterly earnings estimate. The stock plunges another 30%. Panic sets in. The smart, rational Dr. John is gone, replaced by a bundle of raw nerves. All he can think about is stopping the pain. He sells his entire position, locking in a massive loss. He tells himself he is being prudent, cutting his losses. But in reality, he has just executed the classic mistake of the emotionally compromised investor. He bought high on a wave of optimistic storytelling and sold low in a fit of panic. A few months later, the market recovers. Innovate Corp's business stabilizes. The stock begins to climb back. But Dr. John is out. He is broken. He blames the market, the analysts, the company's CEO. He never blames himself, because that would mean admitting his intellect was not enough. That would mean admitting his temperament failed him. This story, in countless variations, plays out every single day. It is the story of smart people who refuse the humility of a circle of competence. They mistake intelligence for wisdom, and they pay the market a very expensive tuition to learn the difference. The direct financial connection between adhering to a circle of competence and your bottom line is stark and quantifiable. It manifests on your balance sheet and in your portfolio's performance in several critical ways. First, and most importantly, it is the ultimate defense against catastrophic loss. The biggest destroyer of long-term returns is not market volatility, it is the permanent impairment of capital. When you invest in a business you don't understand, you are unable to distinguish between a temporary stock price fluctuation and a fundamental deterioration of the business. Like Dr. John, you are more likely to panic and sell at the worst possible time, turning a temporary paper loss into a permanent real one. By staying within your circle, you have the knowledge and conviction to hold on, or even buy more, when a great business you understand goes on sale due to general market panic. This single act of capital preservation is the bedrock of all successful long-term investing. Second, it dramatically reduces costs. Investors who stray outside their circle tend to be active. They are constantly chasing new ideas, buying and selling based on news and tips. This constant churn, this activity, generates enormous transaction costs in the form of brokerage commissions and, more significantly, taxes on short-term capital gains. A disciplined, circle of competence-based approach leads to a low-turnover portfolio. You make fewer, better-informed decisions. You buy great businesses with the intention of holding them for years, if not decades. This allows your investments to compound on a tax-deferred basis, a massive and often underestimated advantage that significantly boosts your net returns over time. Third, it leads to a higher concentration of your best ideas. When your investment universe is limited to what you truly understand, you are forced to be more selective. Instead of spreading your capital thinly across dozens of mediocre ideas, you can make larger, more meaningful investments in the few exceptional opportunities you uncover within your domain of expertise. This is how real wealth is built. It's not by owning a tiny piece of everything, but by owning a significant piece of a few wonderful things. This asset allocation strategy, born from temperamental discipline, focuses the power of your capital on your highest conviction ideas, directly leading to superior portfolio growth over the long run. Ultimately, the circle of competence transforms your financial statement by shifting the odds dramatically in your favor. You are no longer gambling in a casino where you don't know the rules. You are playing a game on your home turf, a game where you have a genuine sustainable edge. This doesn't guarantee you will win every hand, but it ensures that over a lifetime of play, you will walk away from the table a massive winner. That is the tangible financial power of intellectual humility. The second great pillar of Buffett's temperamental framework is his personification of the market itself. He does not see it as an efficient, all-knowing God, nor as a chaotic, unpredictable beast. Instead, he asks us to imagine the market as a single business partner. His name is Mr. Market, and he is, to put it mildly, emotionally unstable. As Buffett's mentor Benjamin Graham first described him, Mr. Market is a manic depressive. Some days, he shows up at your door euphoric. He sees a glorious future for your shared business ventures, and he offers to buy your shares from you at ridiculously high prices. He is swept up in greed and optimism. On other days, he appears in a state of utter despair. He is convinced that everything is doomed, that the world is coming to an end, and he offers to sell you his shares at absurdly low prices just to get out. He is paralyzed by fear and pessimism. Mr. Market has one other crucial characteristic. He is your servant, not your guide. You are free to ignore him completely. You do not have to trade with him, just because he shows up at your door with a quote. The fatal mistake that most investors make, including the very intelligent ones, is that they reverse this relationship. They look to Mr. Market for wisdom. They believe his mood reflects a deep truth about the value of their holdings. When he is euphoric, they become euphoric and buy from him at high prices. When he is despondent, they become despondent and sell to him at low prices. They allow his emotional volatility to dictate their own. The temperate investor, the Buffett-style investor, understands that Mr. Market's quotes are not a measure of value. They are a measure of his mood. And his mood presents an opportunity. The key is to have the emotional stability to divorce your own assessment of a business's value from Mr. Market's daily, wild pronouncements. You do the work to figure out what a business is worth, and then you wait. You wait for Mr. Market to fall into one of his depressive fits and offer you that business for far less than you think it's worth. or you wait for him to be swept up in a manic euphoria and offer you a price for a business you own that is far above what you think it's worth. Your temperament allows you to be greedy when he is fearful, and fearful when he is greedy. You are not smarter than him, you are simply more stable. And in the long run, that stability is the ultimate advantage. Let us travel to the year 1973. The American economy was in turmoil. The Vietnam War was winding down, the Watergate scandal was exploding, and the country was in the grips of a brutal bear market. The Nifty 50, a group of large, popular growth stocks like Polaroid and Xerox that were considered one-decision buys, had collapsed, some falling by 80% or more. Confidence was shattered. Fear was the only emotion on Wall Street. Mr. Market was in the deepest pit of his depression. In this environment of gloom, Warren Buffett began looking at the Washington Post Company. The company owned the iconic newspaper, which was at the peak of its journalistic power, having just broken the Watergate story. It also owned Newsweek magazine and several highly profitable television stations. It was, by any objective measure, a fantastic collection of media assets with strong competitive advantages. Yet, in the panic of the bear market, its stock had been decimated. The entire company was being valued by Mr. Market at around $80 million. Buffett did his analysis. He looked at the earning power of the television stations alone and quickly realized they were worth more than the entire $80 million price tag. This meant that in buying the company at its current price, he would be getting the Pulitzer Prize-winning Washington Post newspaper, Newsweek magazine, and other assets for free. It was an absolutely ludicrous proposition. Mr. Market, in his terror, was offering to sell a dollar bill for 40 cents. The intellectually brilliant investor might have seen this, but then they would have started to second-guess themselves. What does the market know that I don't? If it's so cheap, there must be a hidden problem. The economy is terrible, maybe advertising revenue will collapse forever. They would let Mr. Market's fear infect their own judgment. But Buffett's temperament was his shield. He knew the difference between the value of the business and the quote from his manic-depressive partner. He saw the fear not as a warning, but as a giant, flashing buy signal. Over the next year, he began to accumulate shares, investing over $10 million, a huge sum for his partnership at the time. He wasn't trying to call the bottom. He was simply acting on the enormous disconnect between price and value that Mr. Market's emotional breakdown had created. He wasn't a genius for seeing the value. The value was obvious. His genius was having the emotional fortitude to act on that knowledge when everyone else in the world was screaming, "Sell." Over the next 3 decades, that $10 million investment in the Washington Post would grow to be worth over $1 billion. It became one of the cornerstones of Berkshire Hathaway's success. This was not a victory of complex calculation. It was a victory of temperament. It was the simple but not easy act of recognizing that your business partner was having a panic attack and calmly taking the assets he was desperate to throw away. That is the essence of profiting from Mr. Market. The psychological machinery behind Mr. Market's madness and our flawed reaction to it is explained perfectly by what is known as prospect theory, a cornerstone of behavioral finance developed by psychologists Daniel Kahneman and Amos Tversky, for which Kahneman won a Nobel Prize. Prospect theory demonstrates that humans are not the rational economic actors we believe ourselves to be. A key finding is loss aversion. The pain of a loss is psychologically about twice as powerful as the pleasure of an equivalent gain. Losing $100 hurts far more than finding $100 feels good. This simple asymmetry in our emotional wiring has devastating consequences for investors. When the market starts to fall, as it did in 1973, our loss aversion circuitry kicks into overdrive. Every downtick on the screen is a stab of psychological pain. The natural human instinct is to make the pain stop, and the quickest way to make it stop is to sell. This is why so many people capitulate at the market bottom. They are not making a rational decision about the future prospects of their investments. They are making an emotional decision to stop the immediate suffering. Conversely, when the market is soaring, as it was in the dot-com boom, a different set of emotions takes over: greed, envy, and the aforementioned FOMO. The pleasure of seeing others get rich creates a powerful desire to participate. This drive becomes so strong that it overrides our rational assessment of price. We buy high not because of a sober analysis, but because the emotional pull of the rising tide is too strong to resist. Buffett's Mr. Market allegory is a mental model designed to short-circuit these primal, destructive emotions. By personifying the market as an unstable partner, he creates psychological distance. He is no longer reacting to an abstract, terrifying force called the market. He is simply listening to a proposal from a known neurotic. This reframing allows him to engage his rational brain, the prefrontal cortex, instead of his fearful, reactive amygdala. He can look at Mr. Market's panicked offer to sell the Washington Post for $80 million, and, instead of feeling the contagious fear, he feels a sense of opportunity. He has inverted the typical emotional response. He has trained himself, through this mental model, to feel excitement when prices are falling and caution when they are rising. This is what he means when he says he is, quote, fearful when others are greedy and greedy only when others are fearful. He is not a sociopath devoid of emotion. He is a master psychologist who has understood his own internal wiring and built a temperamental framework to ensure that his emotions serve his financial goals, rather than sabotage them. This mastery of loss aversion is not an intellectual skill learned from a textbook. It is a deep, practiced emotional discipline that forms the core of his investment temperament. To make this powerful concept operational in your own investing life, you need a practical tool, a mental blueprint. Let's call it the Mr. Market checklist. This is a simple process you can run through regularly to ensure you are treating the market as your servant, not your master. Step 1. Before you look at any financial news or stock prices, you must ask yourself a simple question. What is Mr. Market's mood today? Is the general tone of the headlines euphoric or terrified? Are people boasting about their gains or lamenting their losses? This first step forces you to label the emotional environment before you are swept up in it. Step 2. Look at your pre-prepared watch list. This is a crucial element. You must not be searching for ideas in the heat of the moment. You should already have a list of 10 to 15 wonderful businesses that you have studied, that fall within your circle of competence, and whose approximate intrinsic value you have already calculated during a calm, rational moment. Step 3. Now, and only now, you look at the prices. You ask, is Mr. Market in his current mood offering me any of the wonderful businesses on my watch list at a silly price? If his mood is one of panic and fear, he might be offering you your favorite company at a 50% discount to its true worth. Step 4. If the answer to the previous question is yes, you buy. You act decisively, not because you are a genius predictor, but because your flighty business partner has offered you a bargain that you already identified in a state of calm. Step 5. Inversely, you ask, is Mr. Market, in a fit of euphoria, offering me a ridiculously high price for a business I currently own? Perhaps the price has risen to a level that is far beyond your most optimistic calculation of its intrinsic value. If so, you consider selling, thanking Mr. Market for his generosity. Step 6. This is the most important step, and the one that requires the most temperamental strength. If Mr. Market's prices for the businesses on your watch list are neither ridiculously low nor ridiculously high, if they are merely fair, you do nothing. You close your brokerage account. You go for a walk. You read a book. You recognize that your partner is having a moment of sanity, and on such days, there is no business to be done. This checklist transforms you from a passive reactor to a proactive opportunist. It forces discipline and patience. Most days, the correct action will be nothing. But by consistently following this process, you guarantee that when you do act, you are acting with a clear head, exploiting the emotional volatility of others rather than succumbing to it yourself. This is how you systematically turn market volatility, which most people view as risk, into your single greatest advantage. Now let's examine the antithesis, the path of the 99% who fall prey to Mr. Market's charms and terrors. This is the path of the market timer. The market timer is often a highly intelligent individual. She might be an economist or a strategist at a large firm. She is captivated by the intellectual challenge of prediction. She builds complex econometric models incorporating GDP growth, inflation rates, interest rate curves, and dozens of other variables. Her goal is to predict the market's next major move, to call the top before a crash, or call the bottom before a rally. Her entire focus is on predicting Mr. Market's mood swings. She spends her days analyzing charts and her nights worrying about macroeconomic data from around the globe. When her model flashes a sell signal, she liquidates her portfolio and moves to cash, proudly telling her clients she is protecting them from the coming downturn. She might even be right once, perhaps in 2008, and that single correct call becomes her entire identity. She is the one who called the crash. But this success is a curse. It reinforces the belief that prediction is possible. So she stays in cash, waiting for her model to give the all-clear signal to get back in. But the market recovers much faster than she expected. It rips higher, and she misses the first 30%, 40%, 50% of the new bull market, because her model is still telling her a retest of the low is coming. She is paralyzed by her own intelligence. She can't bring herself to buy back in at higher prices, as it would be an admission that her timing was wrong. Years go by. The market continues to climb. The massive gains she missed by being in cash dwarf, the losses she avoided in the crash she correctly predicted. She might have won a single battle, but she has lost the war of compounding. Her clients are frustrated, having watched their accounts stagnate while the world moved on. This is the tragic fate of the market timer. Her intellectual arrogance, her belief that she can outsmart Mr. Market, causes her to miss the single most important driver of wealth. Time in times the market. The temperate investor, in contrast, doesn't try to predict. They admit they have no idea what Mr. Market will do tomorrow. They simply focus on value, and they remain invested in great businesses through thick and thin, using Mr. Market's occasional fits of insanity as opportunities to adjust their holdings at the margin. The market timer tries to be smarter than the market. The temperate investor aims only to be more sane. And sanity over the long term is infinitely more profitable than brilliance. The financial consequences of adopting the Mr. Market mindset are profound and directly impact your journey to financial freedom. The most obvious connection is that it provides a systematic framework for buying low and selling high. This isn't a vague aspiration. It is the direct operational result of the mental model. By separating your analysis of value from the market's daily price quote, you are forcing yourself to only transact when the odds are heavily in your favor. When you buy a wonderful business at 50 cents on the dollar during a market panic, you are not just getting a bargain. You are building in a massive potential for future capital gains. As Mr. Market inevitably recovers his sanity and the price reverts to a more reasonable valuation, your return is amplified. This opportunistic buying dramatically increases your portfolio's long-term compound annual growth rate. Secondly, viewing volatility as an opportunity rather than a risk fundamentally changes your approach to asset allocation and wealth management. The typical retail investor is taught to fear volatility and to diversify excessively to dampen it. But the temperate investor welcomes volatility. They keep a portion of their portfolio in cash or cash equivalents, not out of fear, but out of a readiness to pounce. This dry powder is their opportunity fund. When Mr. Market has his next inevitable breakdown, they are not a seller, forced to liquidate to meet margin calls or quell their own panic. They are a buyer, armed with capital, ready to deploy it at the moment of maximum pessimism. This turns a market crash from a portfolio-destroying event into a wealth-generating one. Over an investing lifetime, experiencing several major bear markets and having the temperament and capital to exploit them is one of the most powerful accelerators of long-term portfolio growth. It is how you can achieve results that are significantly better than the market averages. Finally, this mindset has a hidden but crucial financial benefit. It dramatically reduces stress and anxiety. The investor who is a slave to Mr. Market's moods is on a perpetual emotional roller coaster. This stress leads to poor health, poor decision-making, and a miserable experience. The temperate investor who sees Mr. Market for what he is can observe market crashes with a sense of calm and even excitement. They sleep better at night. This emotional stability is, in itself, a form of wealth. It allows for the consistency and longevity required for compounding to work its magic. By mastering your relationship with Mr. Market, you are not just adopting a superior financial strategy, you are adopting a superior way of life as an investor. The third pillar supporting Buffett's empire of temperament is a concept that flows directly from the first two. If you accept the limits of your own knowledge, the circle of competence, and you acknowledge the emotional instability of the market, Mr. Market, then you must demand a protection against the certainty that you will be wrong and the market will be irrational. This protection is called the margin of safety. Popularized by Benjamin Graham, the margin of safety is the principle of buying an asset for significantly less than your estimate of its underlying or intrinsic value. If you calculate a business is worth $100 per share, you do not buy it at 95. That's not a margin of safety, that's a rounding error. You wait until Mr. Market, in one of his depressive fits, offers it to you for $50 or $60. That gap, that $40 or $50 discount, is your margin of safety. It is the buffer that protects you from bad luck, bad timing, or, most importantly, errors in your own judgment. Many people mistake the margin of safety for a mathematical technique. They think it's about being conservative in a discounted cash flow model. That's the intellectual part, the easy part. The true essence of the margin of safety is temperamental. It is the deep, ingrained humility to admit that your calculations, no matter how detailed, are probably flawed. The future is unknowable. A brilliant new competitor could emerge. A key product could fail. A pandemic could shut down the global economy. The temperate investor doesn't try to predict these things. Instead, they build a financial shock absorber into every single investment they make. The margin of safety is not a tool for maximizing returns. It is a tool for ensuring survival, and in the game of long-term investing, survival is the prerequisite for success. The intellect calculates the value. The temperament insists on the discount. That insistence, that emotional discipline to say no to fairly priced or even slightly cheap assets, is the difference between a good investor and a great one. To see the margin of safety in its most dramatic and potent form, we must go back to 1963 and a bizarre event that came to be known as the salad oil scandal. A company in New Jersey called Allied Crude Vegetable Oil had a massive business. They borrowed huge sums of money against their inventory of salad oil, which was stored in giant tanks. American Express, through a warehousing subsidiary, was one of their biggest lenders. They would issue warehouse receipts for the oil, which Allied would then use as collateral for loans. The problem was that the tanks were mostly filled with seawater, with only a thin layer of salad oil floating on top. It was a massive, audacious fraud. When the fraud was discovered, Allied Crude immediately went bankrupt, defaulting on over $175 million in loans, billions in today's money. Wall Street panicked. The assumption was that American Express, having issued the receipts, would be on the hook for the entire loss. It was an amount that threatened to wipe out the company's entire net worth. Mr. Market had a complete and utter nervous breakdown. The stock of American Express, a blue-chip company known for its travelers' checks and credit card businesses, collapsed by nearly 50%. The consensus was that the company was doomed. This is where Buffett's temperament took over. While others were panicking about the headlines, he decided to do some investigative work. The intellectual part was asking the right question. Has this scandal damaged the underlying earning power of American Express's core businesses? To find the answer, he didn't build a complex financial model. He went to restaurants. He went to banks. He stood on the street and talked to people. He wanted to know, were customers still using their Amex cards? Were they still buying travelers' checks? The answer he found was a resounding yes. The fraud was in a small, obscure subsidiary, but the power of the American Express brand in the minds of consumers was completely untarnished. He concluded that the company's fundamental business was fine and that it could easily absorb the losses from the scandal. He calculated the intrinsic value of the business and realized that due to the market's panic, the stock was trading at a massive discount. The price was so low it offered an enormous margin of safety. The smartest minds on Wall Street were paralyzed by the scandal, the headlines, the uncertainty. Their intellect was focused on the problem. Buffett's temperament allowed him to focus on the opportunity. He famously invested 40% of his entire investment partnership's capital into American Express stock. It was a hugely concentrated, courageous bet, and it paid off spectacularly. As the company absorbed the losses and the market realized the core business was sound, the stock soared. Buffett made a fortune for his investors. This was the margin of safety in its purest form. He didn't need to be precisely right about the exact amount of the final fraud losses. He didn't need to predict the exact day the stock would bottom out. He just needed to be approximately right about the value of the business and buy it at a price so cheap that all the bad news, and then some, was already factored in. The discount was his protection against the unknown. It was an act of financial courage, born from temperamental humility. The psychological foundation for the margin of safety principle is its power as a direct antidote to two of our most dangerous cognitive biases, overconfidence bias and the planning fallacy. Overconfidence is the mother of all psychological biases, the belief that our own knowledge and abilities are greater than they actually are. In investing, it leads us to believe our valuation models are more precise than they can ever be, and that our predictions about the future are more reliable than they are. We fall in love with our own analysis. The planning fallacy is a specific manifestation of this, where we systematically underestimate the time, costs, and risks of future actions, and overestimate the benefits. We believe the new product launch will go perfectly, the merger will have no integration problems, and the economy will be stable. History, of course, is a long series of events proving these assumptions wrong. The margin of safety is a mandatory dose of reality. It is a system that forces you to acknowledge your own fallibility. By demanding a price far below your calculated intrinsic value, you are essentially saying, I have built what I believe is a brilliant and accurate model of this business's future. Now, I am going to operate under the assumption that my brilliant model is completely wrong. This act of intellectual self-flagellation is incredibly difficult for the ego, which is why it's a temperamental, not an intellectual skill. It requires you to kill your darlings, to distrust your own best thinking. It forces you to plan for failure, not for success. A smart investor might spend 100 hours building a model that shows a stock is worth $100. A wise investor will spend that 100 hours building the model and then have the emotional discipline to wait until the stock is at $50 before buying. This is because the wise investor knows that the purpose of the valuation is not to be right about the future. The purpose of the valuation is to identify a price so low that a wide range of futures can play out and you still won't lose money. This fundamentally shifts the goal of investing from making accurate predictions to building in a buffer for inaccurate predictions. This psychological shift is the key to long-term survival and prosperity in a world that is inherently uncertain and unpredictable. How do we take this pillar and build an actionable blueprint from it? The method is a framework I call the 3 valuations. It's designed to force the principle of margin of safety into your decision-making process. For any potential investment on your watch list, you are going to create not 1, but 3 simple estimates of its intrinsic value. First, you create the pessimistic scenario. In this version, you assume things go wrong. Assume a recession hits next year. Assume their main competitor takes 10% of their market share. Assume their input costs rise significantly. What would the earnings and cash flows of this business look like in that ugly world? Based on that, what is a conservative valuation for the company? This is your downside protection value. Second, you create the realistic scenario. This is your base case. Assume the company continues to execute on its current trajectory, growing at a modest and believable rate. Assume the economy has its usual ups and downs. This is the valuation you think is most likely. Third, you create the optimistic scenario. Assume everything goes right. Their new product is a huge hit. They successfully expand into a new market. They gain market share. What could the company be worth if the stars align? Now you have a range of values, from a plausible worst case to a plausible best case. Here is the rule, the temperamental law you must follow. The price you are willing to pay for the stock must be significantly below your pessimistic valuation. For example, if your pessimistic recession-era valuation for a company is $80 per share, you should not even consider buying it unless the stock price is at $60, or ideally, $50. This rule does something magical. It makes it almost impossible to overpay for an asset. It forces an extreme level of patience because opportunities to buy below a truly pessimistic valuation are rare. They usually only occur during periods of market-wide panic or when a specific company is facing a temporary, solvable problem that has scared everyone away, like American Express and the salad oil scandal. Following this 3 valuations blueprint means you will say no to 99 out of 100 investment ideas. Your activity level will plummet. Your ego will be starved for the validation of making a trade, but your capital will be protected by a fortress of conservatism. And when you do act, you will be acting with such a profound advantage, such a massive margin of safety, that the probability of a successful outcome is overwhelmingly in your favor. The antithesis to this prudent path is the well-trodden road of the growth-at-any-price investor. This character is often just as smart, if not smarter in a conventional sense, than the value-focused investor. Let's call her Chloe. Chloe is a tech analyst who came of age during a long bull market. She is brilliant at understanding new technologies and crafting compelling narratives about the future. She doesn't see the world in terms of current earnings, but in terms of total addressable markets and disruptive potential. She falls in love with a company, let's say a software-as-a-service business called FutureCloud. FutureCloud is growing revenues at 80% per year, but it's wildly unprofitable, burning through cash to acquire customers. The stock trades at an eye-watering 50 times annual revenue. To a margin of safety investor, this is an immediate, too-hard-pile candidate. But to Chloe, it's a generational opportunity. She builds a beautiful, complex, discounted cash flow model that projects growth for the next 20 years. To make the valuation work, she has to assume the company will maintain high growth for a decade, achieve massive profit margins that are unheard of in the software industry, and that interest rates will stay low forever. Each of these assumptions is fragile, a single point of failure. But the story is so compelling, the dream of disruption so seductive, that she believes her own model. She buys the stock, and she encourages others to do so. There is no margin of safety. There is not even a margin of error. The valuation is priced for perfection. For a time, as long as the narrative holds, she looks like a genius. The stock continues to levitate. But then, reality intrudes. Growth slows from 80% to a still respectable 40%. A competitor lowers prices. The market, suddenly worried about inflation, decides that unprofitable tech companies are no longer attractive. The spell is broken. The stock collapses 70%, then 80%. Chloe's intricate model is worthless. It was a work of intellectual fiction, untethered from the bedrock of business reality. She has no valuation floor to stand on, because the price was never connected to a conservative estimate of the company's value. It was connected only to a dream. The growth-at-any-price approach is the ultimate expression of intellectual arrogance. It is the belief that you can predict the distant future with enough precision to justify paying a price that leaves no room for error. It is a philosophy that works wonderfully until, suddenly, it doesn't. The margin of safety is the humble admission that you cannot predict the future, and therefore, you must demand to be compensated for that uncertainty in the present through the gift of a low price. The direct financial connection of the margin of safety is perhaps the most powerful of all the pillars. It is the primary governor on your engine of wealth creation, ensuring that you don't blow up before you reach your destination. Its first and most critical impact is the preservation of capital. Peter Lynch once said that the key to investing is not to lose money. A 50% loss requires a 100% gain just to get back to even. The margin of safety is a system designed to avoid these devastating drawdowns. By buying a dollar for 50 cents, you can be wrong about a lot of things and still not lose your principal. The business could perform worse than you expected, and you might only get 80 cents back on your 50-cent investment. You didn't make a fortune, but you didn't get wiped out. This downside protection is everything in long-term investing. Second, the margin of safety is a hidden source of massive upside potential. It provides what the great investor Mohnish Pabrai calls low-risk, high-uncertainty situations. When you buy with a large margin of safety, your risk of permanent capital loss is low. But if your analysis of the business is even remotely correct, your potential for capital gains is enormous. When you buy that dollar for 50 cents, and it eventually gets recognized by the market as being worth a dollar, you've doubled your money. If the business happens to grow, and that dollar becomes worth $2, you've quadrupled your money. This asymmetrical payoff structure, limited downside, explosive upside, is the holy grail of investing, and it is accessible only to those with the temperamental discipline to demand a bargain. This directly translates to a higher return on investment and a faster rate of portfolio growth. Finally, it creates a less volatile, less stressful portfolio. A collection of assets all bought with a significant margin of safety will, as a group, decline less during market downturns. Their low starting valuation provides a natural cushion. This smoother ride helps you stay invested and avoid the emotional mistake of selling in a panic, allowing the magic of compounding to work uninterrupted. The margin of safety isn't just a defensive concept. It is the most potent offensive weapon available to the patient investor, delivering both peace of mind and superior financial returns. This brings us to the fourth pillar, a quality that seems almost un-American in its passivity, yet is the secret fuel of the world's greatest compounding machine. It is the superpower of patience and inactivity. In a world that celebrates action, speed, and hustle, Buffett's temperament champions the exact opposite. He understands that in investing, activity is often the enemy of returns. The smartest people, in particular, often feel a deep-seated need to do something. Their brains are wired for problem-solving, and they feel that if they are not constantly tinkering, trading, and re-optimizing, they are not adding value. This is a fatal temperamental flaw. Buffett's approach is more akin to that of a farmer than a trader. He plants his seeds, his investments in wonderful businesses, and then, for the most part, he lets them grow. He understands that the true magic of wealth creation comes from the compounding of value over long periods, and that this process is disrupted, not enhanced, by constant activity. He has famously said that his ideal holding period is forever. To crystallize this idea, he uses the mental model of a, quote, 20-slot punch card. He tells students to imagine that over their entire lifetime, they have a punch card with only 20 punches on it. Every time they make an investment, they use up one of those slots. With such a finite number of decisions, you would become extraordinarily selective. You would wait for the absolute perfect pitch, the no-brainer opportunity, before you swung the bat. You wouldn't waste a punch on your 57th best idea. This is not a call for ignorance. It's a call for extreme patience. It is the temperamental strength to sit for months, or even years, in cash, waiting for that rare, extraordinary opportunity to appear. Most people, especially the intelligent and ambitious, cannot stand the boredom. Their desire for action, their itch to act, is their undoing. Buffett's genius lies in his ability to equate inactivity with intelligence and patience with profit. The perfect illustration of this principle is not a dramatic stock market play, but the quiet, decades-long story of See's Candies. In 1972, Buffett and his partner Charlie Munger, through Berkshire Hathaway, purchased See's Candies for $25 million. See's was a well-loved, family-run chocolate company based in California. It had a fantastic brand, a loyal customer base, and a simple, understandable business model. Now, imagine what a typical, hyper-intelligent MBA graduate from a top business school would have done after acquiring such a company. They would have launched a synergy task force. They would have created a 100-day plan to optimize operations. They would have tried to expand aggressively across the United States, slash costs by using cheaper ingredients, and rebrand the company to appeal to a younger demographic. They would have felt the overwhelming urge to do things to justify their acquisition and prove their brilliance. Buffett and Munger did almost the exact opposite. They recognized that the magic of See's Candies was its brand, which created immense pricing power. Customers loved the product and trusted the name, and they were willing to pay a little bit more for it every year. So Buffett and Munger's primary strategic decision was inaction. They kept the existing management in place. They didn't mess with the recipes. They didn't try to turn it into a global behemoth. Their main job was to not screw it up. Once a year, they would make one simple, crucial decision. They would raise the price of the chocolates, and every year customers would happily pay it. This simple, wonderful business then proceeded to gush cash. Over the decades, See's Candies has sent more than $2 billion in pre-tax profits to Berkshire Hathaway, all from an initial investment of $25 million. That is the power of compounding in a great business. But the only way to capture that power was to have the temperament to do nothing, to resist the urge to tinker, to be patient. See's Candies required almost no additional capital investment. It was a golden goose that just needed to be left alone to lay its golden eggs. The story of See's is not a story of brilliant financial engineering or strategic genius. It is a story of temperamental wisdom. It is the wisdom of knowing that sometimes the smartest move is no move at all. It is the patience to let a wonderful business do what it does best, year after year after year. The deep psychological reason why this patience is so rare and so powerful is that it fights directly against our innate action bias. This is a cognitive bias documented in numerous studies, which shows that when faced with ambiguity or uncertainty, human beings have a strong tendency to favor action over inaction, even when inaction is the more rational choice. We feel that by doing something, we are gaining control over a situation. A famous study looked at professional soccer goalkeepers during penalty kicks. The statistically optimal strategy for a goalkeeper is to stay in the center of the goal, but they almost always dive to the left or the right. Why? Because diving feels like you are doing something proactive, whereas standing still and having the ball fly past you feels like you failed through passivity. The regret is stronger. The same is true in investing. When the market is volatile, the urge to act, to sell something, to buy something, to reposition the portfolio is almost overwhelming. Doing nothing feels like negligence. It feels like you are a deer in the headlights. This is the action bias at work. It makes us feel in control, while in reality it is causing us to rack up transaction costs, crystallize losses, and sell great businesses for emotional reasons. Buffett's temperamental framework has been built to systematically override this bias. His 20-slot punch card is a mental tool to force inaction. His multi-decade holding periods are a testament to his mastery over the itch to act. He has cultivated what we might call the gardener's mindset. A gardener does not plant a seed and then dig it up every day to check on its progress. That would kill the plant. The gardener understands that most of the growth happens invisibly, beneath the surface, powered by sun and time. Their job is to select the right seeds, plant them in good soil, water them occasionally, and then have the patience to let nature take its course. This is precisely how Buffett views his portfolio. He spends an immense amount of time on the initial selection of the business. But once that decision is made, his default action is inaction. He lets the business compound. He resists the action bias. This is an incredibly difficult psychological feat, requiring a level of patience and emotional security that few possess. It is the quiet confidence to know that you can achieve more by sitting on your hands than a hyperactive genius can by furiously trading all day. To implement this into your own life, you must consciously adopt this gardener's mindset and build a system around it. First, you must separate the activity of research from the activity of transacting. You should be constantly learning, reading, and analyzing businesses on your watch list. This satisfies your brain's need for stimulation and intellectual engagement. but you must create a firewall between this research and your brokerage account. The default outcome of your research should be no action. Only when an opportunity becomes truly extraordinary, a wonderful business on your watch list trading at a massive margin of safety, should you even consider crossing that firewall. Second, create a decision journal. Every time you buy or sell an investment, write down on a single page the date, the price, and, most importantly, a simple paragraph explaining why you are doing it. What is your thesis? What has to happen for this to be a successful investment? This simple act does two things. It forces you to have a clear, rational reason for your action, which can help short-circuit purely emotional decisions. And over time, it creates a powerful feedback loop. You can go back and review your past decisions and see if your reasoning was sound. This helps you learn from your mistakes and improves your process. Third, schedule a portfolio review no more than once a quarter. Do not check your stock prices every day. This is the equivalent of the gardener pulling up the carrots. Daily price fluctuations are just Mr. Market's moods. They are noise, not signal. Obsessively watching them will only engage your action bias and tempt you into making foolish decisions. By setting a specific, infrequent time to review your holdings, you can look at them from a more detached, long-term business owner's perspective, rather than a frantic trader's. Finally, reframe your goal. Your goal is not to beat the market this month or this year. Your goal is to own a collection of wonderful, cash-producing assets that will grow in value over the next 20, 30, or 40 years, securing your financial freedom. This long-term perspective is the ultimate antidote to the short-term noise and the emotional itch to act. It provides the psychological anchor needed to ride out the storms and let the quiet magic of compounding do its work. The antithesis of the patient gardener is the hyper-informed news junkie. This investor is often highly intelligent and prides himself on being on top of every new development. His workstation looks like something out of a NASA control room, with multiple monitors flashing with stock charts, news feeds, and instant alerts. He subscribes to the Wall Street Journal, Bloomberg, Reuters, and a dozen niche financial newsletters. He has CNBC on in the background all day. He is not just a consumer of information, he is addicted to it. Every piece of data is a potential trigger for action. Did the Federal Reserve Chairman use a slightly more hawkish tone in his speech? He sells his bonds. Did an analyst upgrade a tech stock? He buys it. Did a company miss its quarterly earnings by a penny? He sells it. He is a puppet, and the daily news cycle is pulling his strings. He mistakes this constant activity, this frantic energy, for productivity. He feels like a professional, a real player in the market. But what is actually happening to his portfolio? It's being eaten alive. Every trade generates a commission. Every profitable short-term trade generates a hefty tax bill. But more importantly, his decision-making is fatally flawed. He is constantly reacting to noise, not signal. He is selling great companies because of a single bad quarter and buying mediocre companies because of a temporary good story. He never gives any of his investments time to breathe, to grow, to compound. His portfolio is a revolving door of half-baked ideas, driven by the emotion of the moment. The hyper-informed news junkie is intellectually engaged, but temperamentally bankrupt. He has an abundance of information but a deficit of wisdom. He is the perfect embodiment of the action bias, a cautionary tale of how being too connected to the market's daily chatter can be the surest path to financial ruin. He is playing the market's game, not his own, and the market always wins that game. The direct financial connection between patience and your net worth is the most powerful force in all of finance, the magic of compound interest. Albert Einstein supposedly called it the eighth wonder of the world. By minimizing activity, you maximize your exposure to this force. Let's quantify it. First, the impact of taxes and transaction costs. A hyperactive trader might generate a 15% return before costs. But after paying commissions and, crucially, short-term capital gains taxes, which can be nearly double the long-term rate, his net return might be slashed to 8% or 9%. The patient, long-term investor might also generate a 15% return in their underlying businesses, but because they rarely sell, they defer taxes for years or even decades. This allows 100% of their capital to continue working for them. That difference of a few percentage points per year, when compounded over an investing lifetime, is the difference between a comfortable retirement and generational wealth. Second, and more profoundly, patience is the only way to capture the true, multi-bagger returns that come from owning an exceptional business. If you had bought Amazon in 2001 and sold it in 2003 for a quick double, you would have felt like a genius. But you would have missed the subsequent 200-fold increase in its value. The really big money in investing is not made in the buying or the selling, but in the asterisk waiting. It is in the time in the market, not timing the market. Patience is the price of admission for these life-changing returns. By cultivating the temperament to do nothing, you are allowing your best decisions to compound to their full potential. This directly leads to astronomical capital gains and is the surest path to true financial freedom. Patience doesn't just feel better, it pays better. In a world obsessed with speed, the investor's greatest edge is the ability to simply sit and wait. This leads us to the fifth and final pillar of Buffett's temperamental edifice. It is the one that requires the most courage and conviction. It is the principle of concentrated conviction. This idea stands in stark contrast to the conventional wisdom taught in every business school, which is that the key to prudent investing is wide diversification. The mantra is, don't put all your eggs in one basket. Buffett's approach is different. He famously quipped, wide diversification is only required when investors do not understand what they are doing. His view, and that of his partner Charlie Munger, is that it is far better to put your eggs in just a few baskets, and then watch those baskets like a hawk. True wealth, the kind that creates dynasties, is not built by owning a tiny slice of 500 different companies. It is built by making a small number of large, high-conviction investments in businesses you understand deeply and that are purchased with a significant margin of safety. This strategy is the ultimate synthesis of all the other pillars. You use your circle of competence to identify a few businesses you can understand. You use your understanding of Mr. Market and your demand for a margin of safety to wait for the perfect moment to buy them at a great price. And you use your patience to hold them for the long term. But concentration is the final step. It is the courage to bet big when the odds are overwhelmingly in your favor. This is not gambling. It is the exact opposite. It is waiting for that 1 in a million fat pitch, right down the middle of the plate, and then having the temperamental courage to swing for the fences. This requires an iron will, an ability to stand apart from the crowd, and a deep-seated confidence in your own analysis that is not easily shaken by the market's daily moods. The quintessential example of this courageous concentration is Buffett's investment in the Coca-Cola Company starting in 1988. This was not a small, exploratory position. This was a bet-the-farm moment for Berkshire Hathaway. The context is crucial. The market had just suffered the Black Monday crash of October 1987, one of the worst single-day drops in history. Fear was still thick in the air. Mr. Market was skittish and uncertain. In this environment, Buffett began to build one of the largest single-stock positions in history. He looked at Coca-Cola not as a stock, but as a business. And what a business it was. He saw a product that was simple, relatively unchanged for a century, and loved by billions of people around the world. He saw a global distribution system that was a virtually insurmountable competitive moat. Most importantly, he saw a brand that was seared into the human consciousness. A person in a remote village anywhere on Earth might not know who the President of the United States was, but they knew what Coca-Cola was. This brand power gave the company extraordinary pricing power. They could raise their prices slightly each year, and people would continue to buy. Buffett saw that the fundamental business of selling sugar water was completely unaffected by the gyrations of the stock market. The 1987 crash had done nothing to diminish the thirst of billions of people. It had simply made the stock cheaper. So he acted, and he acted with immense conviction. Over the next year, Berkshire Hathaway invested over $1 billion to acquire roughly 7% of the entire Coca-Cola company. At the time, this was a colossal position for Berkshire, representing a huge portion of its investment portfolio. Many observers were critical. They said he was paying too high a price for a mature company. They said he was foolish to concentrate so much capital in a single stock. An intellectually brilliant but temperamentally weak investor would have hedged their bets. They might have bought a little Coke, a little Pepsi, a little Cadbury Schweppes. They would have bought a beverage sector basket. But Buffett had the courage of his convictions. He wasn't interested in his 10th best idea. He was interested in his single best idea. That $1 billion investment in Coca-Cola has since paid Berkshire billions upon billions in dividends and is now worth well over $20 billion. This single, concentrated bet, born from deep analysis and executed with temperamental courage, was a key engine in transforming Berkshire Hathaway into the global powerhouse it is today. It is the ultimate proof that fortune favors not the diversified, but the focused. The psychological force that makes concentrated conviction so difficult is one of the most powerful in human nature: herding behavior and the desire for social proof. We are social animals, hardwired over millennia to find safety and validation in numbers. When our ancient ancestors saw the rest of the tribe running, they didn't stop to analyze the situation. They ran too. The one who stopped to investigate a rustle in the bushes often got eaten. This instinct is still deeply embedded in our brains. In the world of finance, it manifests as a powerful urge to do what everyone else is doing. When a stock is soaring and everyone is buying it, it feels safe and smart to join the herd. When the market is crashing and everyone is selling, the psychological pain of holding on, of being different, is immense. You feel like a fool. You are barraged with questions from friends, family, and the media. What are you doing? Don't you see what's happening? Concentrated investing is the ultimate act of anti-herding. It is a declaration that you believe the entire crowd is wrong. This requires a temperament that is not only comfortable with being lonely, but almost revels in it. It requires an internal scorecard, where your self-worth comes from the quality of your own analysis and your adherence to your process, not from the market's validation of your decisions in the short term. You must be willing to look wrong, sometimes for years. Your big, concentrated bet might underperform the market for a long stretch, testing your conviction to its absolute limit. The average person cannot withstand this psychological pressure. Their need for social proof is too strong. They will eventually crack and sell, often at the worst possible moment, just to relieve the pain of being different. The investor with true temperamental strength, like Buffett, has a different source of validation. Their confidence is not external, it is internal. They have done the work, they have a margin of safety, and they have the patience to wait for their thesis to be proven right, no matter what the herd is doing. This psychological independence is the rarest and most valuable trait in an investor. So how can you apply this terrifying but powerful pillar? You must adopt the mental model of the personal monopoly portfolio. This is a thought experiment that forces the discipline of concentration. Imagine you have that 20-slot punch card we talked about, but let's make it even more extreme. Imagine you have a punch card with only punch point 5 slots for your entire investing life. You can only ever own 5 businesses. That's it. Once you've punched all 5, you're done. This mental framework dramatically raises the bar for any potential investment. It short-circuits the desire for what Charlie Munger calls diversification, the practice of buying more and more things simply to feel safer until your portfolio is a mediocre collection of your 50th best ideas. With only 5 slots, you would not waste a single one on anything less than an absolutely extraordinary opportunity. Before making any investment, you would run it through this filter. You would ask yourself, is this business so wonderful? Is its competitive position so dominant? And is the price so attractive that I am willing to use one of my 5 precious lifetime slots on it? The answer, 99.9% of the time, will be no. This forces you to think like a business owner who is buying an entire company, not like a stock trader who is renting a ticker symbol. You would only seek out businesses that are virtual monopolies in their niche, your personal monopolies. You would wait patiently, for years if necessary, for the opportunity to buy one of these great businesses at a price that offers a massive margin of safety. This mental model is not about being reckless, it's about being radically selective. It's a system for channeling your capital into only your absolute highest conviction ideas. While you may never actually run a portfolio of only 5 stocks, adopting this mindset will fundamentally change the quality of your decision-making. It will instill a temperament of extreme selectivity and courage, moving you from a mindset of collecting stocks to a mindset of curating a handful of truly exceptional businesses. The antithesis of this focused approach is what we can call the index fund purist, who becomes paralyzed by the philosophy. To be clear, for the vast majority of people who have no interest in studying businesses, a low-cost S&P 500 index fund is the best possible investment. But we are talking about the path to truly exceptional, market-beating returns. The mindset of the 99%, even among financially savvy people, is to diversify away all risk. They spread their bets so thinly that no single decision has a meaningful impact on their outcome. They might own an index fund, and then layer on a mid-cap fund, an international fund, a bond fund, and a few individual stocks they heard about. Their portfolio becomes a sprawling, incoherent collection of hundreds, if not thousands, of businesses. They own the winners, but they also own all the losers. Their returns are doomed to be average, by definition. This approach is often rooted in a temperamental flaw: fear. The fear of being wrong is so great that they choose to abdicate the responsibility of thinking altogether. They lack the courage of any real conviction, so they choose to have no conviction at all. They are guaranteed to not fail spectacularly, but they are also guaranteed to never succeed spectacularly. They have diversified away not just their risk, but also their potential for life-changing returns. The concentrated investor, on the other hand, embraces the responsibility. They accept that their success or failure will be a direct result of a few key decisions. This is a path that carries the risk of looking foolish, but it is the only path that carries the potential for true wealth creation. The paralyzed diversifier seeks comfort in the crowd. The concentrated investor seeks fortune in their conviction. The financial connection of a concentrated conviction strategy is the most direct of all. It is the application of leverage to your intellect. If you are truly a superior stock picker with a sound temperament, diversification actively harms your results. It dilutes your best ideas with your worst ones. By concentrating your capital in your 5 to 10 best ideas, you are magnifying the impact of your skill and insight. While a diversified portfolio might grind out an 8% or 10% annual return, a well-managed, concentrated portfolio of wonderful businesses bought at fair prices has the potential to compound at 15%, 20%, or even higher rates over long periods. The mathematical difference is staggering. Compounding at 10%, $100,000 becomes about $1.7 million over 30 years. Compounding at 20%, that same $100,000 becomes nearly $24 million. That is the life-altering power of concentration. This is the strategy that directly leads to massive capital gains and the creation of generational wealth. However, it comes with a non-negotiable condition. It is only effective when combined with the other 4 pillars of temperament. Concentration without a circle of competence is a recipe for disaster. Concentration without a margin of safety is reckless gambling. Concentration without patience will lead you to abandon your best ideas at the worst time. But when all 5 pillars are in place, humility, stability, prudence, patience, and courage, they form an unbreakable framework for wealth creation. They create a temperament that is no longer a liability in the investment process, but the single greatest asset you possess. You have just spent this time re-architecting the very foundation of how you view money, markets, and your own mind. You have moved beyond the noise of stock tips and complex formulas, and into the realm of timeless wisdom. You have acquired a powerful mental tool, the understanding that your temperament, not your intellect, is the ultimate governor of your financial destiny. You now know that the market is a psychological arena, and that victory belongs not to the smartest, but to the most disciplined. You've seen how the circle of competence protects you from your own ego, how viewing the market as the manic Mr. Market turns fear into opportunity, how the margin of safety makes you indestructible, how patience fuels the engine of compounding, and how concentrated conviction can turn great ideas into life-changing wealth. This is a complete system for rational decision-making in an irrational world. But this is just the first, foundational layer. Warren Buffett's system of thought is not a list of disconnected principles. It is a complex, interwoven latticework of mental models. What you have mastered today is the emotional bedrock. But how does this temperament connect to the specific strategies of analyzing a business's competitive moat? How does it inform the way he reads a financial statement? Not as an accountant, but as a detective, searching for clues about a company's character. The framework you now possess is the why, but there are deeper levels, the what and the how, that connect this temperamental foundation to actionable, real-world business analysis. The video that is now on your screen is the next piece of that map. It is the link that connects the psychological to the practical. It bridges the gap between the person you need to be and the things you need to do. This journey is not for everyone. Most people will continue to chase hot tips and get-rich-quick schemes, forever slaves to their emotions. But you have come this far because you are different. You are part of a small group of people who understand that true success is built from the inside out. The choice to click is not just about watching another video. It is a decision to continue your ascent. It is a commitment to completing your mental arsenal, to building not just a portfolio but a fortress of reason and discipline. The next piece of the puzzle is waiting. Complete the map,